Alright, let's have a little chat about the one thing everyone on the internet and at awkward family dinners pretends to be an expert on. Today, I'll explain the stock market to you like you're 5 years old, and by the end of this, you'll finally understand what it actually means to own a piece of a company, why prices wiggle up and down like a hyperactive worm, and how it's all basically just a giant, confusing store for grown-up business parts. So, let's start with the most basic idea. The stock market is a place where you can buy a stock. And what is a stock? A stock is a tiny, little bitty piece of a company. I mean, imagine your friend has a super successful lemonade stand. It's so successful that she wants to build a second, even bigger lemonade stand across town. But she doesn't have enough money. So she comes to you and says, "Hey, if you give me $10 to help me build my new stand, I'll make you a part owner. You'll own a small piece of my lemonade empire." That little piece of ownership is a stock. Sometimes people call it a share because you're getting a share of the company, but it's the same thing. It means that you are now a part owner. You can't just walk in and start making lemonade, but you own a piece of the business. You own one brick in a giant Lego castle. You don't own the whole castle, but you do own that one specific brick. Now, why would a big, important company need your $10? Well, they don't need just your $10. They need millions of $10 from millions of different people. Companies are always trying to grow. They want to invent new gadgets, build bigger factories, or just open new stores in new countries. All of that costs a ton of money. So, instead of going to a bank and getting a giant loan, they sell off millions of these tiny little pieces of themselves to the public. This is called going public. They get a huge pile of cash to work with, and in return, all those people who bought a tiny piece own a part of the company. It's like the biggest bake sale in the world, but instead of brownies, they're selling invisible slices of their business. So, where does all this buying and selling happen? It happens on the stock market, which is also called a stock exchange. And don't think of it as a physical farmer's market anymore. Even though some buildings still exist, it's mostly a giant, super fast computer network that connects buyers and sellers from all over the world. The New York Stock Exchange, or the NYSE, and the NASDAQ are just two of the biggest and most famous playgrounds where all this trading happens. It's an organized system to make sure that when you want to buy a piece of the lemonade company, you can easily find someone who wants to sell their piece. The market is just a middleman that makes the trades happen smoothly, so that nobody gets ripped off. It makes sure that you get your company brick and the other person gets their money. Now for the part that confuses everyone. Why do the prices go up and down all the time? The price of a stock is simply what people are willing to pay for it at any given moment. It has nothing to do with a fixed or secret price tag. It's a massive worldwide popularity contest based on feelings, guesses, and news. So, let's go back to the lemonade stand. If word gets out that your friend's lemonade can cure hiccups, suddenly everyone wants a piece in that company. More people want to buy a share than sell one. And when lots of people want something that's limited, the price goes up. It's basic stuff. But what if a news report comes out that your friend was caught using dirty lemons? Well, everyone who owns a piece gets scared and wants to sell their share immediately. And suddenly, more people are selling than buying. And when nobody wants something, the price goes way down. That's all the stock price really is. It's millions of people every second of the day guessing what a company will be worth in the future. Is the company making a lot of money? Well, the price probably goes up. Did they just invent something amazing? The price goes up. Did their boss get caught doing something dumb on camera? The price probably goes down. It wiggles constantly because news is constant and people's feelings are constantly changing. It's like the price of the hot new toy at Christmas. In December, parents will pay anything to get it. But by February, it's in the discount bin because nobody cares anymore. The toy itself didn't change, but people's desires for it did. Now, you've probably heard people on TV talking about a bull market or a bear market. This is just a silly way to describe the overall mood of the market. A bull thrusts its horns up, so a bull market is when most stock prices are going up for a while. Everyone's optimistic, feeling rich, and buying more stocks. A bear swipes its paws downward, so a bear market is when most prices are going down. Everyone's pessimistic, they're scared, and they're selling things. It's just a label for whether the whole playground is in a good mood or a bad mood. Bull good, bear bad. Simple. Sometimes, if you own a piece of a company, they give you a little treat. This is called a dividend. A dividend is when a company has made a bunch of extra profit and decides to share some of it directly with its owners. You, the owner of a tiny piece, get a little bit of that cash. It's like if the lemonade stand had a really good week and your friend gives you 50 cents just as a thank you for being part owner. Now, not all companies do this. Some younger companies prefer to take all their profits and put them right back into their growing business, like buying a blender for the strawberry lemonade. But older, more stable companies often give out dividends as a little reward to the people who own their stock. Okay, last confusing thing. The S&P 500. Now, I'm sure you hear this one on the news all the time. The S&P 500 is not a single stock that you can buy. It's just a report card for the 500 biggest, most important companies in the United States. It's a list. By looking at whether the S&P 500 went up or down, you can get a pretty quick idea of how the whole American stock market did that day. It's a snapshot, so instead of checking on 500 different companies, you can just look at the one number to see the general trend. Now, you can buy something called an index fund, which is basically a product that automatically buys you a tiny slice of all 500 of those companies at once. It's like buying a pre-made fruit basket instead of picking out every single apple, orange, and banana yourself. It lets you spread your money out easily without having to do a whole bunch of research. It's like betting a tiny bit on every horse in the race rather than just trying to pick one winner. So, let's recap. The stock market is just a big store where you buy and sell tiny ownership pieces of companies. You buy a piece, called a stock or a share, because you think the company will do well and your piece will become more valuable over time. The prices wiggle around all day because millions of people are constantly changing their minds about how much each company is worth, and a bull market means that everyone's happy and prices are up. A bear market means everyone is sad and prices are down. See? It's not magic. Congratulations! You are now officially equipped to nod knowingly the next time someone talks about their portfolio. You get it. I mean, it's not some secret code for rich people. It's just a system for buying, selling, and sharing business parts. So go forth and feel slightly less confused by the world. You're welcome.